Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, December 4th, and this is the weekly market update. So before I do the disclaimer, just to let everybody know, I had a really pretty decent head cold this week, and so that's why I'm late putting the video out. I was down hard probably from Tuesday to, well, yesterday morning. And so I'm will be coughing still a little bit and drinking water during this, so I apologize for the quality, but that we are in the flu and cold season, as they say. And no, it's not COVID, it's just a regular head cold. I had to go get tested for COVID. It came back negative. So getting on with the disclaimer. Anything that you see or hear on the video or on the podcast is not to be taken as investment advice. I'm not a registered financial advisor. I'm just a guy on the internet. Please do your own due diligence. It's your money. It's your responsibility. So the first thing I wanted to talk about was the big sell-off we've had the last 3 or 4 weeks. Really, a lot of the companies that we're involved with have kind of not been doing well since, I'd say, September, October. As the reflation trade looks to be receding. That happens, right? These rotations happen in the market over the short and medium term. And I have talked about in the past about volatility and that we were going to experience volatility. We're going to see more volatility. You're getting a sense of that now. For somebody that's been around for a while, myself, I don't really see a big deal here. When I say that, I don't say that to be glib or to minimize what you may be experiencing, but what's really changed? Mr. Powell said that he threw the transitory thing out in inflation and we might raise interest rates 3 times next year. We might accelerate the taper from 5,000-year lows. Really? I mean, this is the same kind of talk that happened in 2018. If you were around back then, Mr. Powell did that and we had a taper tantrum. The market dropped about 20% and he reversed himself very quickly. What I'm trying to get to the point is the things that we're talking about here have nothing to do with the weekly news reports or minutia of what happens, or what comes out of the mouth of various Federal Reserve folks. Yes, liquidity has helped us. Yes, we are seeing liquidity tighten up around the world, but there's still a ton of liquidity out there and we're seeing rotations now. We're finally seeing a lot of these growth stocks get taken out to the woodshed. These stocks that, if you remember some of the charts I've put up in the past showing some of the companies with 30, 40 times sales, some of these companies got shellacked. I think it was DocuSign's turn on Friday. I think they missed earnings by a penny or something like this, and the stock was down 40%. You're going to see more of this. And so when you start having, we've had a one-way trip with a lot of these high growth stocks. A lot of people are in the market, a lot of retail, a lot of hedge funds, a lot of people have leveraged up, I believe. And Rick Rule talks about this. It doesn't really matter what gets sold when the margin clerk, is sicked on your account. You have to be sold down, and whatever can be sold to meet the margin will be sold. And everything gets sold, right? So across the board. I've said this before. What I like to do in these situations is, I've talked about before, what is the thesis? What is your reasoning for buying these particular companies that are in the portfolio or in your portfolio? You should know what they are. And then you should say to yourself, well, has anything changed in the last week, 2 weeks, 3 weeks to change the basis of my investment in this particular company? And if it hasn't, then you should be buying more. But this is exactly anathema to what most retail investors do. They get scared. They don't really know why they bought things. Somebody on the internet said they should buy it. Their brother-in-law said at Thanksgiving that he was getting rich on uranium. And so, he's a moron and I'm smart, so I'm going to buy. This is what happens. I've talked about this ad nauseum if you've been on my channel. And I can't steady the tiller for you. I can't reach out through this computer screen and tell you it's going to be okay. What I can tell you is my experience of what I've seen and what I'm doing. I think being sick this week kind of took me out of the box. I was laying down quite a bit. I wasn't watching the markets that closely. And so, until I started really looking at things yesterday, late yesterday and today, I mean, I wasn't that shocked of what I saw, but it's what I've seen before. I'm not here to tell you that you should jump in and buy now. The lows are in, buy. I don't know. I can't know the future. I can tell you that the various reasons why I like commodities and resource stocks has not changed. All that has changed is the price. So if you like albacore tuna fish in spring water and it costs $1.50 a can at Kroger and they lower the price to 40 cents, you'll be over there buying as many as you can because you're getting a deal. If the price of the Northern Uranium Trust drops, which I'll show a chart of it, people are emailing me, telling me asking me if the uranium bull market's over. You have to remember what we're trying to do here. Okay, we're trying to catch the, excuse me, the majority of a multi-year move. There are going to be volatile periods. There are going to be 40, 50% drawdowns. This is typical. We went over this before. You have to be prepared for it. You have to be able to purge the fear and the flight instinct that comes into you, which is sell it all and move on. You have to be able to do that. And the only way you're able to do that is if you have your thesis intact, if you have conviction. And conviction comes from understanding why you bought these things and writing it down. And if nothing's changed, I mean, one of the main catalysts that just happened in the last month or two was China announcing they were going to build 150 reactors basically over the next 10 years or whatever it was, 20 years. That didn't change. Was there any announcements this week of billionaire hedge funds or Bill Gates or anybody saying they were going to invest $100 billion on bringing more uranium supply online in the next 3 to 5 years? No, we didn't see that. Nothing has changed in the thesis, except for in the short term, as Buffett says, the market is a voting machine. In the long term, it's a weighing machine. What does that mean? It means that in the short term, volatility and emotion and sentiment rule. And we have, the mob voting for lower share prices. A lot of this, like I said, is from fear. A lot of it is a confluence of events. It's a lot of it people taking profits at the end of the year to lock in their gains, to lock in their bonuses. There's a whole bunch of things going on. And what I don't like to do is what they do on CNBC and Bloomberg. Every time the market farts or goes up, they have to get on there and talk for 4 hours, like Tom Keene and some of these people on CNBC. They get on there and talk for hours because they have nothing else to do, and it sells advertising. Why the market went down or why the market went up. They have to give you a reason. I have no idea why the market goes up and down every day. I'm in this thing for 3 to 5 year moves that, are sectorial cyclical moves. So one of the things I wanted to share with you, I hope that kind of explains where I'm coming from. Okay, what I think about this. Nothing has changed except the prices went down. If nothing's changed and the product you like has got clipped by, in some cases, 20, 30, 40%, you know what you should be doing. It's hard to do that, but that's why most people are not rich from investing in the stock market, because they're unable to do exactly this, step in and buy when things become a value. And so let's look at this. Let me see if I can move my mug here. This is Google's Google search or whatever. You can put terms in and get like how popular the terms are. It's on a scale of 0 to 100. And basically what you have here is the various variants, if you will, of the disease that cannot be mentioned. And this tells you exactly how things work. So you go all the way back to March of this year. And as we spooled up for this particular variant, which I'm not going to say these things because the AI in YouTube is very proficient at dinging videos. So you see this particular one, there was a lot of interest, and then it petered out as the case count went down. Then we had another, back here in September, this kind of was a little bit of a move. And then you just see our new friend here that came up. This thing went straight up and maxed out. So if this was a stock that just went from 0 to 100 in a week, would you be a buyer or a seller? What would be the sentiment? And so what we're seeing is, shoot first, ask questions later, sell, sell, sell. This is just one of many things that's going on. I'm just trying to tell you about how fear sells. The media loves it. This is a reason. Tom Keene and Jim Cramer on CNBC, this is a reason. What if this happens? What if that happens? Europe's locking down. They're locking down. This is going to happen. Very well could happen. We don't know. All it does is postpone the inevitable. What I think the news is beginning to show is that this particular situation is more transmissible but less deadly. And as I think that becomes more clear, if that is in fact the case, then I think that'll be one negative variable removed from the market. But you can see, like I said, this is not a stock that I'd be a buyer of a stock that went from $1 to $100 in a couple days or a week. And what we've seen is not something that's going to be probably a big deal. What you have to understand is the northern climate zones now are entering the winter. You have seasonality to cold and flu season. Okay, so people are going to get sick regardless, because this particular disease that cannot be mentioned has now just become endemic, like the other 200 rhinoviruses that are out there, like the influenza A and B virus, like the H1N1. These things are constantly circulating and constantly mutating. This is nothing new. Oh, it's a mutation. Plan X from Plan B from Planet X. What are we going to do? All these things mutate. All these things are constantly changing. They typically, what do these things want to do? They have one objective in their existence. I don't want to say life, because there's discussion as to whether these things are even alive, because they don't respirate, for example. They want to propagate themselves. And so they have a tendency to mutate unless they are affected with some outside gerrymandering. They have a tendency, not always, but for the most part, to evolve or adapt into being more transmissible and less lethal. That has been the case. In a typical flu and cold season, people are going to 30 to 60,000 people in the US die. And now it's kicking off up north. And so everybody's freaking out. They don't even understand seasonality. They don't understand anything. They don't understand this thing's endemic and is circulating just like everything else that circulates. I just got done having a head cold. It was probably one of the 200 rhinoviruses. Okay, I had RSV because I was in the valley 3 months ago. That was another upper respiratory. I just had bad luck this year with these upper respiratory viruses. Okay, they circulate, people get them. It's not the end of the world. This probably isn't the end of the world either. So that should, but we can wait several weeks and see how the data looks. But that's the initial, seems to be where this data is heading. I think we'll check back in a month and see if this is still, interest in this is still at 100. I doubt it will be. And so you have to take that into account. Okay. And the media, they love to sell fear. If it bleeds, it leads, because it gets eyeballs, it gets interest. You can see the interest here. Everybody's in, oh, what's going to happen? So that's one thing. Powell talking about an early taper or more interest rate increases off a 30 or 5,000 year low, whatever. I mean, nothing's actually been raised yet. Is liquidity tightening around the world? Yeah, it absolutely is. I didn't get a chance to put the CFR. The Council for Foreign Relations tracks that, and they have a scale of +10 to -10. And we were at -10, which is maximum liquidity creation for the last couple of years. So we flooded the world with trillions and trillions and trillions of currency units. And now they're talking about possibly pulling that back. Why? Because inflation's getting out of control all over the world, not just in the US. And they're way behind the curve, just like they were in the 70s. We don't know what's going to happen. We do know, though, if we've entered in, the economy, leading economic indicators, economy is not booming because the base case, but economies are still expanding. Demand for energy is still there. Things were overbought. A lot of people were piled into the energy story, right? That's all people were talking about. So you get way too many people on one side of the canoe and it rolls over. You reset, get back in the canoe. Now people are, what are they doing? They're rotating into consumer staples and all this stuff. You know, these rotations are constantly taking place inside the market. I'm not trying to trade these. Okay. What I do is I take a position early on. I'm still way, way up because I was in these things a long time ago. You know, I have people, longtime listeners to the channel will understand what I have as the newsletter indicator, which is I can tell what sentiment is in the market based on newsletter subscriptions. In September and October, I had the best probably 2 months in the history of the Actionable Intelligence Alert because everything was roaring, right? That's when oil was going to go to 100, uranium was going to go to 200, yada, yada. All the news was out there and everybody was pouring in, remember? Now subscriptions are way down because the last few weeks, everything's got nuked and people are like, well, the shiny object has now become dulled. So here is the North Shore Global Uranium Mining ETF. You can see this thing was way overbought, guys. It was way above. It's pulled back. It's still in an uptrend. This 200-day moving average is still in effect. This thing could come all the way down and kiss this. We've seen it happen before back in late August. Kissed it, bounced right off it. Okay. I'm not saying that's going to happen. I'm not predicting that's going to happen. I'm just telling you that when things are in a bull market, they have this tendency to do this. Okay. They go up, they consolidate the gain, they pull back. That's what happens. Nothing fundamentally has changed in the uranium market for the long term. The short and medium term, anything can happen. How people become wealthy in these type of markets is to put money to work when making volatility their friend, not running away from it. And so as these things pull back, and I mean, we were at 104 and we're down to 77. So I don't know, just on the fund, it's down what, over 25%. Some individual stocks are down 50% from what I've seen. If you like the stock, then you should be a buyer. Same thing in oil, you know, the SPR, the possibility of economic slowdown. What's demand going to do? What's OPEC going to do? It was way overbought. Kind of had like an interim double top here, possibly way above the trading above the moving averages. Sentiment all positive, nobody talking negative, and this is what you get. I can tell you that a lot of the oil stocks that I'm invested in do tremendously well at this oil price. A lot of the companies' cash flow projections are based on oil probably under $60 a barrel. So we'll see what happens. I mean, there's no guarantees. We're in the shoulder season. So we have a lot of things down. But like I said, there's no appetite because did anything change about the lack of investment? Did anything change about demand coming back? Did anything change about the fact that the green transition is going to take longer and cost more money and use more fossil fuel than anybody thought? No, none of that changed. Only thing that changed is price. In the short term, the market is a voting machine. In the long term, it's a weighing machine. We've seen this before. So this is a chart I grabbed, bullish and bearish case for oil in 2022. I thought it was interesting. I want to go over a couple of these points. Let's go over the bearish. New COVID variant threatens oil demand outlook. Check. That could happen. We're seeing lockdowns like in Austria and some other countries. But, you know, oil is used as a transportation fuel. Only about 25% of its use is transportation fuel. It's used in so many other products. So the whole world's not going to lock down. The appetites for locking down is not there. And if this particular variant is not as deadly as previous variants, then this will dissipate very quickly, this particular case. Major consumers plan coordinated SPR release. This is a fart in the mitten. We've already talked about this is nothing. 50 million, 100 million barrels, whatever. They have to buy it back eventually. Are these countries in there buying? And if you look at the nuances of some of the SPR releases, the crude quality and the type of crude, there's a lot of things here. Okay, so this is another one of these things that you get it on the tape and it can cause some short-term negative sentiment. Longer term, it has no bearing. Releasing 50 million barrels, the world uses 100 million barrels a day. It's nothing. It's half a day's oil usage. It's a non-event, but it gets on the wire. And when you're already in a negative sentiment, and you already see Mr. Biden's out there taking credit for it, I mean, it's unconscionable. Market to switch from deficit to surplus. This is a talk that this is something that OPEC has even said. I'm not sure if that's the case. We'll see. OPEC did take the opportunity. If they thought things were going to go from a deficit to a surplus, not sure why they would go ahead with the 400,000 barrel per day increase for December. You recall that they started adding 400,000 barrels of production per day per month, I think starting back in August. So August, September, October, November, December, that'd be 2 million barrels brought online per day of extra. Why would they do that if they felt the market was going to go into surplus? The other thing that's fascinating is we've known and have shown in the past the ability of OPEC to actually bring the production. All of the constituents of OPEC are not able to meet their quotas because of the lack of investment. They're hamstrung. We don't know how bad, but I think we're going to find out over the next year or two. U.S. oil stocks creeping higher after September low. That's true. It's kind of leveled out. We're not seeing the big draws, but we're in the shoulder season. This is pretty typical. So what's on the bullish side? Economic needs may encourage OPEC supply restraint. Well, we haven't seen that. We saw them add 400,000 barrels a day. Higher gas prices encourage more gas to oil switching. We've seen that a little bit, and that's anticipated. We still aren't even into winter yet in Europe, and we still have the record gas prices there, natural gas prices. We'll see. Some OPEC members struggling to pump near quotas. We know that. We just mentioned that. Capital discipline, energy transition, curb investment and output. That's one of the main themes of why we're invested in this sector. Strangulation of investment that will lead to the lack of replacement of reserves and production, which will lead to substantially higher oil prices. So I think our particular thesis is in place. Over the next week or two, we'll see what happens. There's a lot of technical damage. We're at the end of the year. A lot of guys might just pack it in, call it a year, take their profits, lock everything in, get their bonuses, and then we'll just have to see what happens. So difficult to say. Like I said, it's futures completely in the short term unknowable. Shale and producers still not investing. This is your, cash flow, operating cash flow in gray. This is the capex. You see that capex has been on a decline since basically the first. Well, I mean, for a while we had a little bit of a. Basically, I like this line. This is the reinvestment rate and percentage of your cash flow. It's at a record low. Only 40% of cash flow is being reinvested into new production. That's not sustainable. Why? Because the previous managements of drill baby drill have been flushed out. You've got new managements in a lot of these companies who have heard the clarion call from the shareholder and want the cash flow returned to them via buybacks and dividends. And we are in fact seeing that. So yes, people are out there drilling. A lot of them are independent operators. Don't kid yourself. If oil gets to $100 a barrel, everybody will start drilling. I have no doubt about that, but we don't see any evidence of this big push to go back to the way things were before. So I kind of like this quote from Massive Capital. They were talking about the CEO of Yarrow. It's a fertilizer producer. We talked about this before. Stated that the cost to produce a ton of ammonia has increased tenfold from $100 per ton last summer to $1,000 per ton currently. And I like this. This should be like the, excuse me, this should be like the mantra or the logo for Actionable Intelligence Alert. Watch out for unintended consequences in an industrial world when we fail to invest in energy of all kinds. That's what we've done. And we've invested our money, I think, in substandard energy sources. Massive Capital, I do read their work. They are bullish on green energy, but they also are realistic and understand that hydrocarbons are going to be around for decades. But yeah, this is what happens when you have insufficient natural gas to make ammonia and urea and other things. There's so many things that we rely on that we don't even think of. Clean water is one of the major reasons, and proper dealing with sewage in the West is why we have longer lifespans. We don't have dysentery outbreaks. We don't have all disease. We don't have contaminated water. And that's done with chemicals. I worked in a water treatment plant. It was industrial, but the amount of chemicals we use to process and clean up the water for use in the industrial process was staggering. And you can imagine that, like the billions and billions of gallons a day that are processed just in the US, and you don't have outbreaks of all these diseases. And people take this for granted. How much chlorine a year is used for that, right? How much, soda ash is used for different things. People don't give any thought to any of these things until they're not available. And then it's like somebody needs to do something. So here's ammonia prices. We were just talking about that. I guess there's a concern that when you see this big of a spike, you come right back down. So far, we haven't seen that. We don't know when the spike ends, but farmers are already complaining that they're not going to be, subsidies are being given in some countries like India. There's just certainly not enough to go around. And that is going to have a follow through effect because the inputs that are required to get the yields may not be there. You are possibly looking at a season or so of poor crop yields. What does that do to crop prices? That's the thinking here. And that goes back to the unintended consequences. This is an unintended consequence of natural gas prices being at these outlandishly high rates, where people are having to shut in production of ammonia and things like this and for other fertilizers because they simply can't afford to make them or can't even get the gas to make them. So I want to get, here's another example. I want to get into this, the copper. Everybody's talking about the green revolution, but nobody's really thinking about, we've talked about this before, the constituents that are required, the materials that are required to make this happen. So a guy that I admire, Robert Friedland, he's a co-founder of Ivanhoe Mines. He also found the Oyu Tolgoi mine and developed it in Mongolia. He's been a serial entrepreneur. And basically what he said is metals essential to the clean energy transition, such as copper, are enjoying an ocean of capital as investors seek exposure. He goes on to say, now he's known for making outlandish statements, but I kind of like some of the things he says here. We're looking to produce as an industry as much copper in the next 20 years as we did in the last 1,000 years. We need an enormous volume of these metals or we just won't have the transition. Well, we're not going to have the transition because the metals are not going to be produced unless we have substantially higher prices. Where are they going to find all these mines? I'm going to show you another slide from Anglo American CEO where he talks about the same thing. The scramble to bring on more production was also likely to stoke more M&A activity in the sector, he added. But M&A activity doesn't add more metal. It just consolidates the existing metal resources under less and less names. So that might be good for Ivanhoe. They could say they're a bigger copper producer, but doesn't increase the, it's like if we have a pizza and there's 8 slices and I grab 2 of the slices, the pizza doesn't get bigger. There's not more pizza. I have more pizza, but there's not more overall pizza. So the amount of investment, the amount of capital that needs to come in is just not there. This isn't just in oil and gas. This isn't just in uranium. It's all across the resource sector. That's what I'm trying to tell you. This decade, unless you have get hit by a meteor or there's thermonuclear war, there's a complete economic 1930s depression, I just don't see how these resources don't move higher over time. They simply have not made the investments required for the demand that's out there. So here's a quote from the Anglo-American CEO. He tells Mines and Money Conference that the world will need 30 of its, I can't pronounce, it's a mine in Peru. It's their flagship mine they're bringing online in the next 20 years. I think the mine, I looked it up, has reserves of 7 billion pounds of copper, that we need 30 of these in the next 20 years as we decarbonize. Where are they finding copper mines that have 7 billion pounds of copper? It's not happening. This guy says in the end, tough ask. Yeah, it's simply not happening. I'm not even sure if that amount of copper can be found in those volumes. There's plenty of these resources in the ground, but they are getting less and less concentrated. The big, easy stuff has been found. And it's going to take billions and billions of dollars of capital to go out and find this. And it's going to take years. And we've dilly-dallied on this and haven't done it. And that's why we're going to see higher prices. That's going to yield us tremendous opportunity. But if you can't look past what happened over the last month or so, and you're scared out of the market because you haven't done the research or you don't understand what is actually happening, that inability to understand because you haven't done the work leads to the fact that you have no conviction. Of course, you're going to get run out of the market because you're just listening to John or Cuppy or somebody else. You're not doing your own work. And so here, I thought this was an interesting picture I found on Twitter. This is a subsea cable for electrical cable for a wind farm that's offshore. And you can see these are the three phases. It's all copper. I don't know what every single one of these, some of these are probably fiber, communication lines, smaller power, maybe some aux power. I don't know. These are your main, though, cables for transmitting the copper or the electricity that's produced back to the shore. This is 33 pounds of copper per foot in this cable. So how many miles offshore? I don't know. I mean, I'm just giving you what we're up against. The demand for these materials based on what they're talking about doing is almost limitless. And we simply do not have the metal. If you're in a position where you have the metal, you're going to do tremendously well over the next 3, 5, or 10 years, in my view. You're certainly going to do better than if you own DocuSign. That's been my thesis, that the transition from growth for the sake of growth companies in an inflationary environment where the governments are more involved and we're having these mandated transitions to a green economy are going to be so material intensive. I think that's going to cause, at some point, that's probably going to be the end of the resource market when everybody fesses up and says it simply can't be done because we don't have the material. But that's a long, long, long way off in my view. But I think this is the kind of things that illustrate what you're really talking about in real time. Somebody can say, well, John said that, there's so much demand for copper, and what's he talking about? Well, how much copper, how many feet of cable do you need for this particular installation? I don't know. 5,000 feet, probably, a lot more than that. If you're 20 miles offshore, 30 miles offshore, how much is in a mile? 150,000 feet of cable at 33 pounds. I mean, you're talking, millions and millions of pounds of copper. How many of these installations they plan on building? I mean, I see it where I'm at, just the amount of copper we use, excuse me, building these solar and wind farms. Crazy, dude. All right, so that's it for this week. That's about all I got in me. Like I said, I'm not feeling that good. I hope this was useful to you. I hope that you get something out of these videos. Like I said, I can tell by the viewership on YouTube, the amount of people signing up for the newsletter, that sentiment is horrible. But we've been through these periods before, and there may be more pain to come. I do not know. I cannot know the future. But I will tell you that currently I am still long-term invested, and I've been putting more money to work in some of the names that I like. And this is the time to do that. If you're going to be run out, then like I said, you probably shouldn't have been in it to begin with because you don't understand what we're doing and why we're doing it. That's not to throw brickbats at people. That's not to tell people, be negative towards people. That's just reality. And you're playing for keeps here. This is real money. This is the real deal. This is the major leagues. And, the money and wealth typically transfers from the less informed and naive to the most informed and people that have the most experience. It's just the way it is. All right, guys, that's it for this week. Appreciate you tuning in, and we will talk to you next week. Thanks.